A single housing loan quietly becomes the foundation of an entire financial system. The decision looks simple. The structure beneath it spans decades. In the early 1950s, a policy choice is made to standardize the home loan at 30 years. This extends affordability. It also extends institutional exposure far into the future. Before this standard, most home loans lasted 5 to 10 years. Borrowers refinanced frequently. Lenders carried short exposure matched to short funding sources. The 30-year term changes this relationship entirely. The lender now holds an asset for 3 decades, but deposits and savings backing that loan turn over in months or years. This gap between short funding and long assets is called a duration mismatch. It is not unusual in finance, but at national scale, it requires a continuous management system to remain stable. The Federal Housing Administration, and later Fannie Mae, are created to absorb this mismatch. They purchase loans from banks, freeing lenders to issue new ones. The mismatch moves to the institution, not the bank. Banks now originate loans and sell them quickly. Their exposure lasts weeks, not decades. The duration risk is transferred to a government-backed entity holding it permanently on behalf of the system. For 2 decades, this system works smoothly. Interest rates stay low and stable. The mismatch remains invisible because funding costs and loan yields move in the same direction. Then, in the 1970s, inflation rises sharply and interest rates follow. This is the stress the duration mismatch was always vulnerable to. Short-term funding costs rise. Long-term loan yields stay fixed. Savings and loan institutions are most exposed. They borrowed short and lent long on a massive scale. When funding costs exceed loan income, every institution holding fixed-rate mortgages loses money every month. The 30-year fixed rate was not the cause of this failure alone. It was the starting constraint. Every institution that issued these loans was operating inside a structure designed elsewhere and inherited as fixed. By the early 1980s, over 1,000 savings institutions are technically insolvent. Their assets are worth less than their liabilities. The system continues operating only because regulators allow it to remain open. Congress responds by deregulating savings institutions. They are permitted to invest in higher-risk assets to recover lost income. This does not fix the mismatch. It adds a new risk layer on top of it. The savings and loan crisis ultimately cost the federal government approximately $160 billion. Most of this is absorbed by taxpayers. The duration mismatch from 3 decades earlier is the original load-bearing failure. The policy response does not eliminate the duration mismatch. It institutionalizes it more deeply. Fannie Mae and Freddie Mac are expanded to absorb what private institutions can no longer hold. Fannie Mae and Freddie Mac are called government-sponsored enterprises. They carry an implicit government guarantee. This guarantee is never written into law. It exists only as a market assumption backed by institutional history. Because investors believe the guarantee exists, Fannie and Freddie can borrow at near government rates. This cost advantage allows them to undercut private competitors. The implied guarantee is now a structural market subsidy. Through the 1990s and 2000s, Fannie and Freddie grow substantially. They purchase and guarantee trillions in mortgage assets. The duration mismatch, originally distributed across thousands of small lenders, concentrates into 2 entities. Concentration changes the risk profile of the entire system. What was once spread across thousands of institutions is now held in 2. A stress event affecting both simultaneously is no longer local. It is systemic. Meanwhile, the 30-year fixed mortgage remains the dominant product because it remains the most affordable option for borrowers. Demand for it grows. The institutional infrastructure required to support it grows proportionally. Future videos will examine how similar structural assumptions accumulated inside other financial systems and became permanent fixtures rather than temporary supports. Subscribing ensures those patterns reach you as they are released. In 2003 and 2004, private label mortgage-backed instruments began competing with Fannie and Freddie for the same loan volume. To maintain scale, both entities began purchasing lower-quality mortgage assets. The constraint shifts from duration to credit. Both duration risk and credit risk now accumulate together inside the same institutions. Each risk was individually manageable in isolation. Their combination inside a guaranteed entity changes the exposure profile of the entire national mortgage system. At this point, the 30-year fixed mortgage is not simply a loan product. It is a political and social commitment. Any reform to the duration structure would reduce affordability immediately. The cost of reform is visible. The cost of continuation is deferred. This is the asymmetry embedded in the original decision. Affordability is immediate and visible to voters. Duration mismatch is delayed and invisible to most observers. Political systems consistently prefer visible benefits and deferred costs. In 2008, housing prices decline and mortgage default rates rise. Fannie Mae and Freddie Mac face losses on both their credit guarantees and their own portfolio holdings. The implicit government guarantee becomes explicit almost immediately. The U.S. Treasury places both entities into conservatorship in September 2008. The government injects over $190 billion to stabilize them. The implicit backstop, assumed for decades, is now a formal commitment on the public balance sheet. The conservatorship was described as temporary when announced. Both entities remain in conservatorship today. No legislative reform has successfully restructured the system built on the 30-year fixed mortgage and its required institutional support. The 30-year fixed mortgage now represents the majority of new home loans issued in the United States. No comparable private market exists to replace the government-backed system. The original product design has become the only viable option at scale. Reform proposals surface regularly. Each faces the same structural constraint. Any change that reduces the government guarantee raises mortgage rates for borrowers. The political cost of reform remains immediate and visible. The cost of the current system remains distributed and deferred. This dynamic has a name in policy analysis. It is called path dependence. Once a system reaches sufficient scale and embeds enough stakeholders, the cost of reversal exceeds the cost of continuation, regardless of which choice is more efficient. Other countries do not use the 30-year fixed-rate mortgage as the primary product. Most use adjustable rates that reset to market conditions. The duration mismatch is transferred to borrowers in those systems rather than to institutions. Neither approach is inherently superior. Each distributes the duration risk differently. The U.S. version placed it inside guaranteed institutions. The recurring question is whether that placement is sustainable at its current scale indefinitely. The total mortgage market backed by government-related entities now exceeds $7 trillion. This is not a temporary exposure created by crisis. It is the baseline operating condition of the U.S. housing finance system as currently designed. The duration mismatch is not growing in an unchecked or chaotic manner. It is managed carefully by professional institutions with sophisticated tools. But managed risk and eliminated risk are not the same thing. Management requires continuous resourcing and attention indefinitely. The original post-war decision created a system that works well under stable conditions. It provides affordable, predictable housing finance to millions of households. These outcomes are real and substantial. They are also the reason the system is difficult to change. The constraint created in the 1950s is now embedded in property values, household finances, institutional mandates, and legislative commitments simultaneously. Each layer of embeddedness makes the next layer of reform more costly to contemplate or execute. This is the mechanism that transforms a reasonable policy decision into a permanent structural commitment. The decision does not become permanent because it was flawed. It becomes permanent because it worked well enough, long enough, to build everything else on top of it. Fannie Mae and Freddie Mac remain in conservatorship more than 15 years after they entered it. The debate over their future continues. Each proposed resolution involves trade-offs that return, in some form, to the original duration mismatch created in the 1950s. The system continues to function. Mortgages are issued. Homes are purchased. Institutions manage their portfolios. The duration mismatch that began as a policy decision now operates as load-bearing infrastructure. It is present in every new loan made today. The original decision made sense within its context. It expanded homeownership at a moment when that was a national priority. The consequences that followed were not failures of logic. They were the natural result of a system expanding beyond the scale its original structure was designed to hold. The two scaffolded buildings stand in conservatorship. The housing market continues operating around them. A decision made to solve a problem in one era became the foundation of a system that now cannot easily exist without it.